video will provide you an explanation to this homework problem about payroll and all the corresponding liabilities that go with it. So I'm assuming you've worked through this problem that just summarizes up here all of the taxes and withholdings relative to this gross pay amount that happened on December 31st for Strong Inc. And we're asked to prepare the entries for the company related to payroll, and then comment how the balance sheet and the income statement would be affected by this transaction. So first off, what I've done is just put this little picture together for us, because I think it's important to remember the context of what's really happening here. So on one side of the transaction, we've got the employer, and that's the side of the transaction we're trying to summarize or account for through the journal entry. And they've got this group of employees here that's worked for them, and the contract between the employees and the employer was, we'll pay you some sum of money, and that could be a salary or an hourly rate. But the workers work, they then are eligible to receive this money. However, the IRS and other government agencies step in and they say, wait, not so fast. This money doesn't go directly to the employees, because we cannot trust that they would remit the appropriate taxes to the taxing authorities. So what happens is these government agencies come in, and then they force the organization or the employer to remit the taxes on behalf of the employees. So what happens through this transaction, remember we're looking at their accounts, is the gross pay gets split. Some of it goes to the employees, but some of it goes into these, I'll call them buckets or current liabilities, to be paid or remitted to the corresponding authority at a later date. So these are the withholding taxes, and maybe any benefits like 401k or health insurance. The company will withhold that from their check. So this would be gross pay, and this would be net pay, how much actually shows up on the check. And then the difference gets remitted to these other agencies by the organization. So the way I answered this problem, and I'm sorry for some of the distractions here with the pictures, but so what I did here was I set up this little table, and you can see that right here. And this just summarizes all of the information that's been presented to us in the problem. And I've got two columns here. I've got one for the employer, and I've got one for the employee. And remember, not all taxes are subject to both the employer or the employee. And remember, we're the organization, and we've got to make a determination as to which account is affected, and so keeping them separate is important. So I'm not going to go through in detail. You can go up and figure out where these corresponding tax rates come from. But the other thing to remember is this ceiling that exists, and these actually can be quite tricky. So we're looking at unemployment for the state. Most states levy unemployment and force the employer to pay on behalf of the employee a percentage of the wages, but they stop. They have a ceiling, and most often, and this changes over time, about $10,500. Once the employee makes any more than that, they don't levy the tax. So it stops after that. So you can see up here, payroll in excess of this amount was $375, and I'll walk you through how that actually gets calculated in a second. But most importantly, I think, is you need to understand which taxes are and aren't paid by each individual here. State unemployment is never paid by the employee, nor is federal unemployment, and it's always paid by the employer. The Social Security and the Medicare taxes are paid by both the employer and the employee. They both share in paying that tax. So the first thing I want to do is record the payroll, get the wages payable into my income, into my balance sheet, and the wage expense onto my income statement. So I should debit wage expense, and this will be for the gross amount of the payroll. And up here it says $500,000. So that shows up on the income statement as an expense in the current accounting period. But remember, I'm holding on behalf of the employee now. So gross goes into the income statement, but the balance sheet now, I'm holding on their behalf all these different amounts, and that's what's really going on in this part of the journal entry. Is I'm going to create all of these little buckets, or these current liabilities, and I'm going to put in there the amount I'm holding out of their check. So the federal withholding here is $85,000. and that would come from a calculation that a software program would do for the organization. State income tax, same thing. Taxes levied by the state on the individual, so $70,000. And then I have these union dues payable, 10,000. So these are easy because they're already calculated for us. But now these Social Security and Medicare withholding taxes, I've got to calculate. Now, again, also remember that what I'm doing here is I'm figuring out gross to net. Wages payable is how much I'll actually pay the employee. That's how much their actual check would be, the amount of cash that they're receiving. So we're going to calculate how much Social Security is going to be withheld from their check. Remember, they are subject to 6.2%, but there's a ceiling. It stops after $118,000 of wages, and that's the 2015 figures. And any dollar amount above that they don't pay. So I've got to interpret what does that mean in the context of this problem. If gross pay is $500,000, how much of that is subject to the 6.2%? It's the end of the year, so logically employees would have earned, if they're a high wage earner, they may have exceeded this ceiling, and that's what this is telling me here. Payroll in excess of $118,000 is $350,000. So that means I've already exceeded the $118,000. I've paid taxes to that limit, and of this $500,000, I don't have to pay the tax on $350,000. So I do have to pay the tax on $150,000. So my formula here is going to be $150,000 times the tax rate. The employee pays that, the employer also pays that. That's a matching amount. So when I look at the Social Security withholding, remember withholding is how much I'm holding out of their check. We'll deal with the employer's portion later. So that $9,300 comes out of their check. And I do the same thing for the Medicare. Now the current Medicare rates are 1.45% up to $200,000 of wages in a calendar year. Once an employee exceeds the $200,000, the rate actually increases. So we've got to figure out which rate and how much of it is applied to this $500,000 up here. So the payroll right here in excess of $200,000 is zero. That means all of this $500,000 is subject to the 1.45%. So my formula says the $500,000 times that tax rate. And again, the employer matches that, but in this portion of the problem, this journal entry, we're only dealing with the employee's portion of the withholding. So now what we've got everything within the context of this problem that the employer is holding on behalf of the employee in these buckets. So that means if our contractual agreement was $500,000 of wages, but we're really going to withhold these amounts, put them in a bucket, we're only going to cut a check to our employees of $318,000. So that's one part of this journal entry, and that's to record the payroll. But what also happens at some later date, probably within a couple of days, we're actually going to turn this payable into cash. We've got to pay them, so this is fairly easy. I thought I'd just throw this in here. So this payable goes away, and we actually pay the employees the cash. We cut them the check. So there's this period of time that lapses between when the payroll is run and when the checks are actually cut and distributed to the employees, and that's what's going on here. The checks are given to the employees. So the last thing we're going to do is record the employer's payroll taxes. And so these items hit the income statement in the current accounting period for the employer. It's a cost of having employees. They've got to pay this portion of the taxes. So we can already see what's happening. We know the Social Security and the Medicare amount, and we can just go ahead and plug those in here. Social Security, so we're going to match the employees, and the Medicare, we're going to match the employee as well. My state unemployment tax, we got to calculate it. Remember, there's this ceiling, so in excess of $10,500 of wages, we don't pay any more tax. So we've got to go up here and figure out how much of the $500,000 is above that ceiling. And that's what's listed right here. So it's telling us $375,000 is above this ceiling. So that means $125,000 is subject to the tax. So my formula will say $125,000 times the tax rate, $67.50. That's the amount of taxes I will have to pay at some point. Currently, I owe it to the government. Haven't paid it yet. And we'll do the same thing with the federal unemployment. What you'll notice here is it has a $7,000 ceiling. and the problem tells me there are $400,000 in excess of the 7,000. So of the 500,000, 100,000 is taxable. So my formula says 100,000 times the tax rate, 800 bucks. So the payroll taxes that the employer is responsible for because of the current tax laws are all of these added together, $24,100. So what you'll find here is the employer has, in the income statement, they're going to expense in the current accounting period when the wages were actually earned $500,000 in the gross pay, plus an additional amount of the payroll taxes that they have to pay on behalf, well, not on behalf, but they have to pay because of the current tax laws and having employees in the corresponding state that they're located in. So the balance sheet, the liabilities, these are all current liabilities, and I like to think of them as buckets. They sit out there on the balance sheet. We haven't paid them yet. We're the organization. When we pay them is subject to the different rules and laws, and they get fairly complicated on how big the company is, but and which authority. Social Security Administration has authority over the Social Security and the Medicare taxes, and the IRS and the state. And when we pay them just depends on what they are. But until then, they sit out there on the balance sheet as a current liability, which affects the liquidity of this organization, and correspondingly, the expenses are expensed in the current period, and that's when the payroll was earned. Now, one last thing I just want to show you, I know this video is getting fairly long, is this here. Most months have, some have more than 4 weeks, some have slightly less, but if this is December, and it's the last day of the year, because the problem tells us up here that this is December 31st. Now, the way most organizations work, some of them pay every 2 weeks, some pay once a month, some pay weekly. But let's say this was a bi-weekly pay period. This is the day when I calculate the payroll, I create all the journal entries I just did. But the problem is that only covers typically the prior 2 weeks if it were bi-weekly payroll. So the checks are cut and distributed to the employees here, but it doesn't include any wages from this current week, which causes an issue in an accounting context for us, because we expense the item when it's actually incurred, and, subject to the matching principle rules. So this 1 week's worth of pay or work that the employees have actually worked for the organization isn't reflected in the income statement or the balance sheet, and that's problematic, and that's the need for accruing payroll, wages and taxes, which is beyond the scope of this problem. But I hope you found this helpful, and we actually did go through and answer both of the requirements to this problem.